Duolingo is a stock that had massive growth expectations embedded in it, and many investors thought they would be a sort of category killer in education, weaponizing AI to absolutely dominate this category and expand out from language learning to all sorts of different lessons like math, chess, but really everything that can be taught. Instead, what ended up happening was growth decelerated starkly, and now the stock is down 75%. Whereas revenues grew 40% in 2025, next quarter, they're guiding bookings to grow just 6%. So the key question investors have to ask here is this a business model that is broken? Or is some of this actually self-inflicted? And could this be an inflection point, maybe an opportunity for investors? We will cover that in this video update on Duolingo. In case you missed it though, one of my first deep dives I've ever did was actually on Duolingo. This is several months back. That's gonna have much more context and background on the business. This is gonna be an update to that video. However, I did talk more about Duolingo, and honestly, one of my favorite videos I put out so far, which was called How to Pick Winning Growth Stocks. There was a whole section that was timestamped just on Duolingo, but we're going to talk a little bit more about that and the issues that I kind of saw coming with Duolingo. And so without further ado, let us get into it, and let us start with a little bit of context, starting with 3Q25. So in that quarter, they posted 33% bookings growth. Now, I'm going to talk a lot about bookings growth instead of revenue growth. That is just because bookings is a more forward-looking indicator. So revenue growth is going to eventually follow bookings growth. And when the company slows its growth, as it has been doing, if it does it consistently long enough, the two will converge. So that's why I'm focusing on bookings growth. And in this quarter, 3Q25, this, in my opinion, was the quarter where things really started changing for the business. So they, at the time, posted 33% bookings growth, but then guided to a stark deceleration of 22%. Now, the CEO, Louis von Ahn, at the time said that this was because they were going to focus less on monetization. They were going to curtail some unhinged marketing that they were doing, instead really focus on the key value prop and incorporating AI in order to make it a better app. Now, at the time, I thought this was a little suspicious because it wasn't entirely clear to me why you couldn't do both, why you couldn't continue to grow and also just invest more into the business. Now, it makes sense that some of the things they were doing with monetization, specifically this transition they did moving from hearts to energy, which kind of capped the amount of time a user can spend on the app without paying. That did seem like that was something that could curtail growth, but at the same time, that could be a way to actually increase monetization because you're forcing more of these free users into the paid tier because they can't play on the app as long. And so in this quarter, this, in my opinion, was where there started to be what we could call some red flags, some sort of issues that didn't really make total sense. And I talked about some of them at the time on Twitter and also in that earlier video I did. So the following quarter in 4Q25, they did post 24% bookings growth, which just slightly beat at the high end, but then they guided again to another deceleration, this time 11% bookings growth for the quarter. So this is now the second consecutive quarter of bookings growth really falling a lot. And then in the following quarter, they posted 14% bookings growth. So they beat that number by a little bit. But then you know where this is going. They guided again to a deceleration, this time of bookings growth of just 6% for 2Q25. So you have a company that was growing 40% revenues a year ago, and now they're guiding bookings growth to just 6%. So this is a really strong drop off that rightly had a lot of investors concerned. Now, there's been a lot of reasonings attributed to this slow off and the stock price downfall, but I think a lot of it honestly is just wrong, because at least what I've seen is a lot of people have been very worried about AI. They've been saying that AI is going to kill Duolingo, or there's going to be a lot more app competition because it's a lot easier to make apps, or people will use ChatGPT to learn languages. I think that has nothing to do with the issue with Duolingo. That is my opinion. And I think all of that is kind of a red herring. I think that these are not the issues that Duolingo faces today. And I don't think that ChatGPT or just AI in general is actually a threat to Duolingo. I think what's really happening is just a more classic growth issue. And that's why I use Duolingo as a sort of case study when I was analyzing how to think about growth businesses. Because what's really happened here, in my opinion, is a company was just growing very quickly and they ran out of users for their existing value prop. So my hypothesis of what's really gone wrong with Duolingo is simply that their product didn't have enough users that really resonated with it. And if you recall, there was kind of two things I was saying that Louis von Ahn wanted to strategically shift in 3Q25. So the two big things he said was, we're going to curtail unhinged marketing. And the second is we're going to focus more on making Duolingo a better educational tool, incorporating AI. So whether they did this with AI, without AI, I think the idea is the same, which is that they needed to improve the product. They needed to make Duolingo a better app to actually learn a language or learn anything in general. Now, these two things together, to me, sort of suggested more underlying issues with the business than maybe was apparent to a lot of investors, because you have them changing their product, you have them changing their go-to-market strategy. At the same time, you have them saying that we're not going to monetize as aggressively, and we're going to do that in order to basically reopen our funnel for growth so we could get more people back in. And what we've seen since that's ended up happening is yes, some of this I do think was self-inflicted, where they have been monetizing less, and you have seen that show up in the bookings number fall off. So there is an aspect of this that is self-inflicted, but it's not like we immediately saw, the user growth numbers increase a lot. In fact, monthly active users were up only 6% year over year in the last quarter, and that's been consistently dropping. And instead they've said, let's focus more on DAUs. So DAUs were up 21% in the last quarter year over year, which is really strong, up to 56 million users using the app every day. However, that's still down from a year ago of them being at 48%. So this is still a very stark deceleration in growth, despite the fact that they've been making these efforts. And I know they're still early on in all of this, but these are just some of the things that to me suggest bigger underlying issues with the core product. And so my hypothesis is that many people think, or they advertise themselves as a language learning app, but I don't think that's how most people really use the app. If we think about the sort of consumer hierarchy of preferences, which is what preferences or what needs are being fulfilled by you using a Duolingo app, I don't think it's, I want to learn a language. Instead, I think it's more like, I want to have a little bit of fun learning some words. I want to maybe have a score streak that I could keep posting, be a little social with my friends and post that online and go back and forth with them. And then I also want to have a gamified experience, and I don't want to spend very long on this app either. And in fact, they copied Spotify and did this wrapped data sort of thing at the end of the year, where they said how long you were on the app and then what % of user you were, basically. And people took this data, and it was very easy to find out that if you spent about 2 to 3 minutes on the app a day, you were in the top 10% of all users. So over 90% of users are spending under a couple minutes a day on the app. That is not very good usage, and you're certainly, I'm sorry to tell you, not going to learn a language by spending just a couple minutes a day on the app. So to me, what this is they had a product that they were very good at advertising and marketing a lot for. And there are a lot of people that did enjoy using the app, but at some point they realized this wasn't really going to allow them to actually learn a language. And so many of them churned off of the app forever. And the ones that stayed, it's less about really learning a language, and it's more about, having fun learning a little bit. It feels kind of good to spend a few minutes in there. You feel like you learn a couple words, but you're not going to get to fluency really by just using the Duolingo app. Certainly there's some exceptions, but by and large, that seems to be the case. Now, if we look at their existing monthly active users of about 130 million, and we make some simple churn assumptions, it's pretty likely that they've had over 500 million registered users on the app at some point. So what that means is that they've actually churned through a lot of their potential addressable market, and these users aren't coming back. And this is key to them dropping the unhinged marketing, because the marketing originally was designed to get people to download the app and try it, right? You know, they have all these different funny ads out there. It's very viral. And sure, I'll try Duolingo. It's a free app. Once you get to the app though, and you realize it's not really doing something for you, it's not really fulfilling different preferences. Specifically, it's not that easy to learn a language. It's not that much fun learning it on Duolingo. Maybe it's better than alternatives. You churn. And you're not going to come back to the app just because you see another unhinged marketing campaign. Maybe you'll come back though if you get a different message from them. If you get a message that suggests the app has changed, that there is more value they are providing. So I think that's the first reason why they changed their unhinged marketing tactics, because they said it was, oh, this isn't really the way we want our brand to be perceived anymore. I think that's kind of BS. I think it just wasn't working the same way because they're still using those same tactics in newer markets. So I think it's very effective to get users onto the platform and to try the product, but it's not going to be effective marketing to reacquire churned users. And growth going forward for Duolingo is going to rely a lot more on reacquiring customers who tried the app and left. And that's usually a harder thing to do because now people have perceptions of what the app is. And very often, if they left, they're not positive perceptions or neutral at best. And so I think that's the first thing and the first reason why they had to curtail and change this unhinged marketing that I don't think people fully caught on. This was not a good development. Even though this was a very good way to get users onto the platform, it's not going to be effective reacquiring churned users. So I think that's the first thing. And that, together with the fact that they said they need to increase their value prop, basically, they said we need to get better at education and we need to help people actually learn languages. It suggests that their core value prop, the existing product, is just not good enough for what most people want. So this is my hypothesis of what's been going on with the business, why growth has decelerated so starkly. And I think CEO Louis von Ahn was very early to catch on to this, noticing that this was where the business was trending. And so rather than letting this be a slow bleed, they kind of accelerated it in a way. They said, okay, we're not going to focus on monetization right now. We're going to really just focus on the product a lot. And instead of trying to get extra, money from existing users, let's make the product better. Let's create more consumer surplus first. So it's kind of a mix of both, of the business model kind of deteriorating, not working the way it had for the past, decade plus prior, plus the fact that they did have an opportunity to incorporate AI to actually make it better. And so they did self-inflict a little bit of this pain, a little bit of this growth slowdown. Instead of pulling more growth levers, they're now back to the drawing boards trying to increase the value of the product. So just backing up for a second, I want to kind of emphasize that a good business is a business that's able to create value for a consumer and then monetize a portion of that value. But they typically want to keep what's called a consumer surplus, which to me means that they're fulfilling more consumer preferences than are necessary in order to get a sale for the product. So what that means in layman's term is I feel like I'm getting so much more value out of Duolingo than what I am currently paying for that. And that just wasn't the case for most people. And so that's why they've emphasized product issues more. That's why they've leaned a lot on AI to roll out a lot more courses, a lot more lessons, using AI conversations so people can talk to an AI figure and use their language skills. They're also now doing AI adventures to try to simulate real world sort of cases of when you would need to use a language. So all of this, to me, it's the right way to go. And it makes sense that they're doing this. But the fact that they had to do it, it's not a positive. They saw this growth slowdown coming, and so this is how they figured they should react to it, which to me, it makes sense as the right strategy, but we also don't know to what extent they're going to be successful yet. Maybe we find out that Duolingo as a mobile app, it's really good is somewhere in between a sort of game with a little bit of light learning, but it's not the right form function for someone to really sit down and really hammer out an hour-long educational lesson. Duolingo may not be the right product for that. Maybe, on the other hand, they can figure it out. I honestly don't know, and I don't take a big opinion on this. What I would emphasize, though, is that when a company does have a stark deceleration in growth, it's a very hard thing to re-accelerate growth, which is what they are calling for in the back half of this year. They're calling for bookings to grow 10.5% year over year versus 2Q going to be at 6%. So that does imply in Q3, Q4, bookings re-accelerate again. And so That could very much be the case. And then there's a secondary question of whether or not that's enough growth at current valuation levels to warrant an investment and what the implied return is going to be, which we'll get to in a moment. The big thing I want to emphasize, though, is that when a company is growing very quickly and they're adding a lot of new users, it's hard to understand what the retention is of existing users. So with these unhinged marketing campaigns, it was clearly very effective in them getting a lot of new users into the app, but what was missing was how many users were leaving. That means we also can have a great understanding of how much users really appreciated the existing value prop. So I talked about in this growth video that I did, trying to understand what is good growth versus bad growth. One of the big differences in growth between eBay and Amazon was Amazon actually was growing slower than eBay, but they were much better at retaining users than eBay was. eBay was growing quicker, but a lot of new users, they would try eBay out, then eventually, they'd get ripped off by someone on there, or it was too much friction in order to make a purchase with all of the auctioning, the back and forth, making sure the merchant is legitimate, that they eventually stopped using the app. And this kind of goes to show that real valuable growth is when you're able to retain existing users, even if that means you're growing slower. What I would love to see as an investor is the difference between new user growth versus existing users that continue to use the app. And what the wrapped data suggests to me, where we found out that a lot of users don't use it for more than a couple minutes a day, is that that's a very tenuous grasp on the user. If you're using, Duolingo for a couple minutes a day, it's probably because you get a bunch of notifications and you feel bad if you don't use it and you want to keep your score streak alive. It's not really because, you're dying to go back to the app and really learn a language. You certainly can't learn one in a couple minutes a day. So this is my thoughts on what's actually happening with the product and the business and some of the struggles that they've been going through. And I also just want to take a meta lesson from this, which is this is what happens when you invest in growth stocks and they don't meet expectations. You could see these very, very sharp drawdowns. A lot of times when I invest in businesses, to be honest, I really am uncomfortable assuming any high level of growth. Yes, that means you miss some opportunities, but it also means you potentially missed, investing in Duolingo at $300, $400, $500 a share, where you were kind of just assuming that they would continue to grow 30% plus, and now they're doing 6% in bookings next quarter. So these are situations you want to try to avoid, and of course you could decide however you want to build your portfolio. If you want to invest in growth, you probably want to have more bets because a larger portion of them aren't going to go well, and you're going to want to size them smaller and accordingly. And so that's kind of a topic for another video, but I just want to emphasize this because we do talk about a lot of growth companies where I kind of quickly go over this assumption that, oh, this company will grow 20%, 30% a year for 5 years, 8 years. And I want to give a bigger asterisk around that to just show you this is a case of what happens when they don't. You don't have any downside valuation protection, right? Because you were assuming that it would be able to grow earnings enough that in the future, those earnings would cover the existing valuation. And maybe it was already priced for a certain level of growth as well. And when that doesn't come, the drawdown can be really, really rough without really much downside protection. Now, I will say a few things about Duolingo that I think are rather positive. One is that it is very hard to create a mobile app business that is profitable. It can generate $1 billion in revenue. Right now they're doing $1.1 billion. That was a very hard thing for them to do, and they already had to beat out a lot of different competitors. I think a lot of the moves they've done in the past couple quarters in order to make their value prop better, it's exactly what you would want to see a founder-owned business do. It makes sense to me. You're going back to the roots. You're going back to first principles. How do I provide a better product for the customer? Now, all of this, though, ultimately still means it's a little more ambiguous whether or not they're going to get that right mix. Now, I think it makes sense, when you're using AI, you're not only able to create a lot more content. They talked about how they did 20,500 courses alone in the last quarter, whereas a year ago they did 7,800, and 2 years ago they did 1,800 a quarter. So that is how much AI is allowing them to accelerate their product roadmap. They're rolling out a lot of new categories, chess, math, a lot of other ones as well, which are attracting more users. So that could potentially open up the TAM as well. Ultimately, the key question is whether or not they can create a product that sort of serves a higher consumer preference than what they're serving right now, which is a little bit of like a gamified learning experience. If you could actually teach someone a language, people will pay a lot of money for that. And maybe you end up having fewer users that you monetize at a higher rate, which is a fine conclusion, because ultimately what they want to do is they want to help people learn. And that is a much more valuable sort of service than what they're currently doing. And I say this as someone who's used Duolingo. I have friends that use Duolingo. I used it for like 6 months or so for Mandarin, and it helped me with like a handful of words, and it just really wasn't a great way to learn in my experience. And I've had other friends that used it as well, where you'd use it right before you go on a trip, or you kind of feel like, I'll learn a new language, and you're into it for like 3 months, 6 months or something like that, and then you fall off. Maybe you learn a few handful of words, but it's still not quite good enough to really teach you a full language, nor do you really have that expectation, at least for myself, that I was ever going to become fluent just using Duolingo. And so I think that if they're able to move up to a higher value activity, like really teach someone something thoroughly, whether it's a language, math, music, whatever it is, that's a much higher value activity that they can monetize at a much higher rate. Certainly more than, $60 to, $100 a year per user. And so I think they're doing the right things, but this transition is still not over yet. But ultimately it comes to what is priced into the stock, and now the stock is around $132 a share. The expectations of what you need to happen are much, much, much lower than before. So at $132 a share, you have about a $5 billion enterprise value, because they do have a little bit over $1 billion in cash. Now, the way I'm going to look at valuation for this business is I'm going to take their 100 million DAU target by 2028, and I'm going to apply the current ARPU they're currently generating. So if we take their total revenues right now, 1.1 billion roughly, divide by 56 million DAUs, they're making about $21 per user. Now, I know that's not a perfect translation, because yes, they have a little bit of advertising revenue on the freemium users versus the paid users, but roughly speaking, I think it's okay we use this. So $21, we're going to keep that flat, and if they could get to 100 million DAUs, then you're getting $2.1 billion in revenue. Right now, operating margins are around 14.5%. Let's say they could get that to 25%. I think there could be more upside from there, but let's just use that 25% figure for now, a little bit of conservatism there. Tax it 20%, and you get about $420 million in NOPAT. Now, if you're comparing that to their current enterprise value, that means they're basically trading at 12 times probably 2029 earnings, something like that, these earnings estimates that we have. And yes, of course, you can increase the ARPU if you want. You could increase the margin if you want. I'm just giving you a framework to think about it. These, to me, they seem reasonably conservative estimates if they're able to actually achieve what they're talking about. So if they are able to do that, these estimates put them at 12 times 2029 earnings. And I say 2029 instead of 2028, because if they get those 100 million users by the end of 2028, then that'll be, the following year when that actually ends up happening. Now, let's say you put a 20 times multiple on that, which it depends how much they're growing ultimately, whether or not that's a fair multiple. If they're growing a high single digit number at that point, 20 times is probably fair. If they are able to re-accelerate growth, grow a mid-teens number, I think 25 times can be fair. If they could get, to 20% plus growth at that point, which would really be fantastic, really re-accelerating growth, 30 times plus multiple could be fair. Now, if we are using just the 20 times multiple though, that's going to be about a 20% annualized return from here. And I'm basically assuming that investors are willing to pay that 2029 earnings estimate we have in 2028. So it's that year is not accounted for in the CAGR, because you're paying a multiple of forward earnings. So that gets you a pretty solid return, right? But you still have to have the company go from generating right now, 6% bookings growth to really re-accelerating that a lot, which means you have a lot of faith in management. You have a lot of confidence in this product and this business. For a lot of investors, they will not consider that to be a conservative assumption. I typically don't invest in turnaround companies just because the risk associated with it is much higher. I usually don't want to make the assumption that growth is going to have to re-accelerate a lot, because it's just not a conservative assumption to make, at least if you're not dealing with a cyclical business, which is kind of a different bucket from here. Having said that, there's always exceptions. And that really is because when you're dealing with the turnaround situation, the risk of them not executing really increases, because you're not talking about a management team using the same playbook they were using before in order to just attack broader opportunities that already exist in the market. Now you're talking about them doing something different. I don't know if the new way they're going to market without the unhinged marketing is going to work as well. It seemed like, that marketing strategy was really one of the best, marketing strategies any mobile app company has ever had. And so how much success are they going to have with a new advertising strategy? I don't know whether or not customers that have already churned from Duolingo are going to be willing to give them another chance. I don't know if they're going to associate Duolingo with really truly learning, or if it's more just kind of a gamified learning experience. Now, there's certainly caveats to every rule, and I've made exceptions myself. I just want to emphasize it's not a conservative assumption to make that, bookings are going to reaccelerate from a mid-single digit growth to 20% plus, which is what is implied in the math that we just did. And some investors may want to jack those numbers up even more. And so you're certainly free to assume whatever you want. My advice would just be very cognizant of the assumptions implied in any sort of return math that you're doing. So if you are doing this math out of what the valuation could look like in the future, and you did kind of the same framework we just did, look at what that implied growth rate for revenue is assuming. Are you comfortable with that assumption, with that much of a reacceleration of growth? Some people, they can gain confidence in some businesses that other people may want to pass on the opportunities. That's what makes a market. But if you want to better understand growth investing and some of the things we covered in this video, I highly recommend you watch this video first. It's honestly, I think, one of the best videos I've ever done. And thank you for watching, and until next time.